Listen to me very carefully, because I am only going to say this once. The Federal Reserve Bank just made 3 announcements, and the financial media is going to spend the next 72 hours turning those announcements into background noise, into filler content, into something you scroll past while you eat your lunch. That is exactly what they want. That is exactly what keeps the average person poor, confused, and completely at the mercy of decisions being made in rooms they will never enter, by people who do not care whether they survive this economically or not. I have spent decades in the markets. I have moved billions of dollars based on exactly these kinds of moments, the quiet announcements, the dry press conferences, the technical language that sounds boring on the surface but contains the blueprint for who wins and who loses over the next 5 years. This is one of those moments. And if you walk away from this video without understanding what just happened, you are handing your financial future over to people who will spend it without a second thought. Before I go any further, I need you to do one thing. Subscribe to this channel right now, not later, not after the video, right now, because what I'm about to walk you through is the kind of macroeconomic intelligence that private wealth managers charge their clients $10,000 a year to receive. I am giving it to you for free, but only if you are in this community. Hit subscribe, hit the notification bell, and then pay attention, because every word I say from this point forward has dollar signs attached to it. Here is what actually happened. The Federal Reserve Bank sat down, looked at the state of the American economy, looked at inflation, looked at the labor market, looked at global oil prices and geopolitical instability, and they made a decision that they would cut interest rates by exactly 0% and raise interest rates by exactly 0%. They froze. Now, I want you to understand something, because the financial media is going to frame this as stability, as caution, as prudent central banking. It is none of those things. When the most powerful financial institution in the world, the institution that controls the price of money in the global reserve currency, looks at the economic landscape and says, we genuinely do not know which direction to move. That is not stability. That is paralysis. That is an institution staring into a room and not being able to tell whether a floor is solid or whether it is about to give way. And it gets worse, because this was not a unanimous decision. This was the most divisive vote inside the Federal Reserve Bank that we have seen in decades. You now have Fed members sitting across the table from each other, and some of them are saying that we need to raise interest rates right now to defend the dollar before it deteriorates any further, while the other camp is saying that if we raise interest rates, we will collapse the economy and trigger a recession that will be far more damaging than the inflation we are trying to fight. These are not fringe positions. These are voting members of the Federal Reserve Bank, and they are in fundamental disagreement about the direction of the most important price in the global financial system. When the generals are fighting each other over the battle plan while the enemy is advancing, you do not call that a stable situation. You call that a crisis in slow motion. Now, the third announcement is the one that I want you to pay particular attention to, because most people are going to miss the significance of it entirely. Jerome Powell is stepping down as chairman of the Federal Reserve Bank. His term expires May 15th. We already knew that. What we did not know, what Powell announced, is that he is not leaving the Federal Reserve Bank's board. He made a very specific, very deliberate statement, and I want you to absorb every word of it. He said he will not leave the board until the Department of Justice investigation is well and truly over, with transparency and finality. Read that again slowly. The outgoing chairman of the Federal Reserve Bank just publicly tied his continued presence on the board of that institution to a Department of Justice investigation. That is not a routine transition of power. That is a man using his institutional position as a shield and his continued influence on monetary policy as leverage. Because here is what matters from a pure mechanics standpoint. The Federal Reserve Bank makes its decisions by majority vote. There are 12 voting members. Jerome Powell, even without the title of chairman, retains his seat and his vote. President Trump believed that by replacing Powell with Kevin Warsh, he was getting a new vote that would move the institution toward lower interest rates. What he is actually getting is a new chairman operating inside a board that still contains the man who has been the single biggest obstacle to the rate cuts Trump has been demanding. The chessboard just got significantly more complicated. Now I want to talk about something that I call the net interest trigger. And I want you to understand this concept as clearly as you understand your own mortgage payment, because it is going to define the next decade of American economic life. The United States government currently carries more than $39 trillion in national debt. I want you to sit with that number for a moment, not as an abstraction, not as a statistic you have heard before and filed away, but as a real operational financial reality. $39 trillion is money that the United States government has already spent without having it. It borrowed that money from American citizens through the purchase of Treasury bonds. It borrowed it from foreign nations, including Japan, China, and the United Kingdom, and it borrowed a significant portion of it from the Federal Reserve Bank itself, which we will get to in a moment. The consequence of that debt is that the United States government is now paying more than $1 trillion per year in interest alone. Not principal repayment, not investment, not infrastructure or defense or social programs, pure interest, money that exists for the sole purpose of servicing the cost of past borrowing. And where does that money come from? It comes from one source and one source only, which is your tax dollars. This means that approximately 20 cents of every single dollar you pay in federal taxes this year is going directly into an interest payment. It is not building a road. It is not funding a school. It is not going to a veteran or a hospital or a research program. It is going to lenders, foreign governments, institutional investors, and the Federal Reserve as the cost of borrowing money that was already spent before most of you reading this had ever filed a tax return. Now, here is where the net interest trigger becomes critical to understand. The Federal Reserve Bank has historically operated with two primary mandates. The first is price stability, which means keeping inflation at a manageable level, historically around 2%. The second is maximum employment, which means keeping the labor market healthy enough that Americans can find work. Those have been the two North Stars of Federal Reserve policy for decades. But there is now a third pressure building that is not officially part of the mandate, but is very much part of the reality. That pressure is the cost of servicing $39 trillion in debt at interest rates that are higher than they have been in over 2 decades. At some point, and serious economists are now debating not whether, but when, the Federal Reserve Bank will be forced to make a choice between fighting inflation on behalf of American consumers and keeping interest rates low enough that the United States government can continue to borrow the money it needs to function without triggering a sovereign debt crisis. That is the net interest trigger. And the fact that it is being discussed inside the Federal Reserve Bank in the same week that Jerome Powell is stepping down and Kevin Warsh is stepping in is not a coincidence. It is a signal. And the people who read that signal correctly are going to be in a fundamentally different financial position than the people who ignored it. Let me tell you about Kevin Warsh, because most people know his name, but have no idea what he actually stands for or what he is planning to do with the Federal Reserve Bank. Kevin Warsh is not Jerome Powell. Jerome Powell was cautious, methodical, and deeply committed to the traditional framework of inflation targeting. Kevin Warsh is different. He comes in with a specific agenda, and I want to walk you through exactly what that agenda looks like and why it represents the biggest gamble in American monetary policy in at least 40 years. First, Kevin Warsh wants to cut interest rates, not because inflation has been solved. It has not been solved, but because he believes the economy needs stimulus and that the current rate environment is creating unnecessary pain for businesses and consumers. If interest rates come down, mortgage rates come down with them. If mortgage rates come down, more people can afford to buy homes. More people buying homes means more furniture, more appliances, more construction, more hiring, more economic activity throughout the entire chain. If interest rates come down, car loan rates come down. It becomes cheaper for businesses to borrow money to hire workers, expand operations, and invest in new capacity. On paper, this sounds exactly like what a slowing economy needs. And in isolation, it might be, but we are not operating in isolation. Here is the brutal mathematical reality. If mortgage rates drop to 4% tomorrow, you would see a surge of buyers entering the housing market unlike anything since 2021. And what happens when demand surges without a corresponding surge in supply? Prices go up, bidding wars return, houses sell above asking price, and the inflation that the Federal Reserve Bank has been fighting for the past 3 years gets a direct injection of fuel. That is the fundamental tension that Warsh is walking into. Cutting interest rates is stimulative. Stimulation when inflation is already running above target is dangerous. Warsh knows this, and this is where his second lever comes in. Kevin Warsh has stated that he wants to cut interest rates while simultaneously shrinking the Federal Reserve Bank's balance sheet. Now, I want to explain what that balance sheet actually is, because the way most people understand it is incomplete. The Federal Reserve Bank is not a bank in the traditional sense. You cannot deposit money there. It does not hold cash reserves in a vault. What it does is operate as the lender of last resort for the United States government. When the government needs to borrow money and issues Treasury bonds, the Federal Reserve Bank is often the buyer, meaning it prints the money to purchase those bonds, which is how the government gets funded. Over the past several years of quantitative easing and pandemic stimulus, the Fed's balance sheet swelled enormously because it was printing money and buying government debt at a massive scale. Warsh's argument is that if you cut interest rates to stimulate the economy while simultaneously selling those Treasury bonds back into the market, which removes money from the financial system, you can theoretically balance the inflationary pressure of lower rates against the deflationary pressure of a shrinking money supply. In theory, this is elegant. In practice, it has never been executed successfully at anything close to this scale, and the assumptions it rests on are, in my professional assessment, dangerously optimistic. Here is where I need you to follow this chain of logic all the way to the end, because most people stop halfway through and miss the part that directly affects their life. If the Federal Reserve Bank starts selling its Treasury holdings, meaning it stops being a buyer of U.S. government debt and becomes a seller, what happens to the Treasury market? Basic economics tells you the answer. When supply increases and demand stays the same or decreases, prices fall. When Treasury bond prices fall, Treasury yields go up. That is not a coincidence or a side effect. That is the direct mathematical inverse relationship between bond prices and bond yields. It is the iron law of fixed income markets. Now, why does that matter to you personally? Because every major loan product in the United States economy is priced in direct relationship to Treasury yields. When your bank sits down to calculate what interest rate to charge you on a 30-year mortgage, one of the primary reference points it uses is the yield on the 10-year Treasury bond. The logic is straightforward. The bank has money to lend. It can lend that money to you, or it can lend that money to the United States government by buying treasuries. The government is considered a risk-free borrower because it has the legal authority to raise taxes and, in collaboration with the Federal Reserve, to print money to repay its debts. You are not risk-free. You could lose your job. You could get sick. You could make financial decisions that impair your ability to repay. So the bank charges you a premium above the risk-free Treasury rate to compensate for the additional risk of lending to a human being instead of a sovereign government. This means that if Kevin Warsh's balance sheet reduction strategy causes Treasury yields to rise, which is what traditional economics strongly suggests will happen when you remove one of the largest buyers from the market, then your mortgage rate goes up, not down. Up even if the Federal Reserve Bank has technically cut interest rates, because the rate that the Fed controls directly is the federal funds rate, which is the overnight lending rate between banks. The mortgage rate you pay on your home is determined by the Treasury yield, which the Fed influences but does not directly control. So you could end up in a scenario where the Fed cuts rates. Headlines say rates are coming down, and yet your actual mortgage payment goes up because Treasury yields moved in the opposite direction from Fed policy. This is not a theoretical scenario. This is a plausible outcome of exactly the policy combination that Kevin Warsh has described wanting to implement. And if Treasury yields go up, it is not just mortgages. It is a car loan. It is a business credit line. It is credit card interest rates. It is student loan refinancing rates. It is every financial product that touches the credit markets, which means it touches your life whether you think you are paying attention to the bond market or not. And the downstream consequences of that do not stop at your personal balance sheet. They travel through the entire economy. If borrowing becomes more expensive, consumer spending slows. If consumer spending slows, businesses generate less revenue. If businesses generate less revenue, they stop hiring. If they stop hiring, unemployment rises. If unemployment rises, and if tax revenues fall, the government has to borrow even more money to fund itself, which puts more supply into a treasury market that is already struggling to find buyers, which pushes yields even higher. This is what an economic feedback loop looks like when it runs in the wrong direction. And the people who will feel it first and hardest are not the institutional investors with hedged portfolios. They are the people who are living paycheck to paycheck in a house with a variable rate mortgage, driving a car they financed at 7%, carrying a credit card balance at 22%, and watching your grocery bill climb every single month without understanding exactly why. So what do you actually do? Because I am not here to scare you and leave you with nothing. I am here to tell you the truth and give you a specific course of action. Let me be direct with you. The window between now and May 15th, when Kevin Warsh officially assumes control of the Federal Reserve Bank, is one of the most important planning windows you are going to have in the next several years. After that date, the uncertainty becomes operational. The changes stop being hypothetical and start showing up in markets, in rates, in prices, and in your paycheck. So here is what you need to do in specific and mathematical terms before that window closes. The first thing you must do is conduct a complete audit of your debt exposure right now. Write down every single debt you carry, every mortgage, every car loan, every credit card, every personal loan, every student loan. Next to each one, write down whether the rate is fixed or variable. If you are carrying variable rate debt and Treasury yields rise the way I have described, your minimum payments are going to increase automatically and you will have had no warning. You need to know exactly where you are exposed before the market moves, not after. If you have the ability to convert variable rate debt to fixed rate debt, you need to have that conversation with your lender immediately. Not next month. Immediately. Because once yields move and banks reprice their products, that option may be significantly more expensive or unavailable entirely. The second thing you must do is stop using the government's reported inflation rate as the basis for your financial planning. The reported consumer price index is a measurement tool that has been redefined repeatedly over the past 50 years. The way we measured housing inflation in 1975 is fundamentally different from the way we measure it today. The categories included, the weightings assigned, and the methodologies used have all shifted in ways that, not coincidentally, tend to produce a lower reported number than what most Americans actually experience when they look at their grocery receipts, their rent statements, and their utility bills. The real inflation rate, the one you feel in your actual cost of living, is meaningfully higher than the reported 3% figure. Your financial planning needs to be built around the real number, not the official one. If you are making savings and investment decisions based on a 3% inflation assumption when your actual cost of living is rising at 6 or 7%, you are systematically falling behind without even knowing it. The third thing you must do is position your assets in a way that does not depend on the Federal Reserve making the right call. Because based on the divisions I described at the beginning of this video, the likelihood of them making a clean, correct, well-timed call is not high. What does that mean in practical terms? It means that sitting in cash, in a savings account, in a money market fund, in any dollar-denominated instrument that simply tracks the dollar's value is not a conservative strategy in an environment where the dollar's purchasing power is being eroded by inflation that runs faster than your interest yield. It means that you need exposure to real assets, things that hold value independent of what the dollar does. That includes real estate with fixed-rate financing. That includes commodities and commodity-linked investments. That includes equity in businesses with genuine pricing power, companies that can raise their prices in line with or above inflation without losing customers. And it means understanding that waiting for certainty before you act is the strategy of people who have never actually managed money at scale. In markets, certainty arrives after the opportunity is passed. The people who profit are the ones who read the signals early, position accordingly, and have the discipline to hold their position while everyone else is still debating whether the signal was real. Let me leave you with one more number that I want you to carry with you. The average American household is poorer today in real purchasing power terms than it was before the pandemic, not because wages went down. In many cases, wages went up, but because inflation, running at the pace it has since 2020, has outstripped wage growth for the median American worker. Your paycheck is larger in nominal terms. It buys less in real terms. That gap between the number on your pay stub and the actual purchasing power of that number is going to widen or narrow based on the decisions being made right now inside the Federal Reserve Bank and the United States Treasury. And now you understand those decisions in a way that 95% of the people you know do not. The question is whether you are going to use that understanding or whether you are going to close this video and go back to being surprised every time your cost of living goes up. Here's my final word to you, and I want you to hear it clearly. On May 15th, a new era of American monetary policy begins. Kevin Warsh is walking into the chairmanship of the Federal Reserve Bank with an aggressive agenda, a divided institution, and a predecessor who is staying on the board to protect himself from a federal investigation while retaining a vote on the decisions that affect every financial product in your life. The playbook that worked for the last decade, borrow cheap, buy assets, let inflation do the work, is changing. The variables are shifting. The risk profiles are shifting. And the people who are going to come out of this next period ahead are not the people who were the luckiest. They are the people who understood what was happening, made a specific plan based on that understanding, and executed that plan before the majority of the market caught up. You now know what is happening. You now know the stakes. You know what the net interest trigger is. You know what Kevin Warsh is planning and why it is uncertain. You know how Treasury yields affect your mortgage, your car loan, and your credit card. You know that the real inflation rate is higher than what is being reported, and that your savings are losing purchasing power right now. But today, regardless of what the headlines say, the only remaining question is whether you are the kind of person who does something with that knowledge or the kind of person who watches it happen to them. I have worked in finance long enough to know that the second group is always larger than the first. Do not be part of the second group. Share this video with someone who needs to hear it. Subscribe if you have not already, and start making your moves right now before the window closes and the new Fed era makes the current decisions look like the easy ones.